Hello friends, this is Professor Amarjeet Kaur. I am Professor of Accounting and Business Communication in the Department of Management, Gurugram University, Gurugram. I am a student of accounting and keep on learning. So this is a great opportunity to learn when I am here with you, through your reviews, through your feedback. So friends, today's session is on cost of capital. Under cost of capital, we are going to talk about one specific cost, cost of debt. So the topic of the session is cost of debt, which is actually part of cost of capital. So friends, financial management is very important subject in in any master's degree or undergrad degree of management, commerce. Even in engineering, basic financial management is being taught. Even in hospitality industry or tourism industry, we teach accounting and basic finance. In fact, finance is something which is known, which should be known to everyone, every single individual, or either working in marketing or HR or accounting or finance section. Finance is not something to be learned by the people who work in finance sector only. It is to be learned by every single individual like me or you who are not working in financial sector, BFSI sector or in accounting or finance department. Why so? Because we all need funds for our basic needs, and we earn our salaries or our profits, or if through jobs, then revenue, and then we have to ensure that we are in, if we have savings, we are investing it at the right place, we are getting the right return, right? And that return which you are expecting out of your investment is cost to the company you are investing in, or cost to the bank you are investing for, in even if for FD, bank is paying you interest, that is a cost to them. So understanding financial management and its all aspects of investing, financing, etc. are very important. In this respect, one of the decision is about financing. For meeting up the individual needs, you need financing, you need to borrow from different bank for your car loan, as car loan, as house loan. So are the businesses, even they need to borrow from individuals, or they need to raise capital, be it equity or preference, to meet up their needs to expansion or sales, etc., or even for working capital requirement. So in this regard, if company is raising debentures, bonds or term loans, if it is raising debt, right, then it is paying some interest to the investors. If you have given debt to company, you become debenture holder, you become investor for the company, right? If bank is given some loan to the company, that bank become investor. If SIDB is giving, for example, or any other financial institution is giving some money to the business, bank become investor. And every investor, be it individual or institutional or corporate, they need return on it, right? So the return which company has to give to the investor is cost of capital, cost of debt, in fact, to the company, and that is returned to the investor. Okay. So in this regard, the cost of debt is very important to be learned. So what is cost of capital? The for the issuing firm, the cost of debt is the rate of return required by investor, adjusted for flotation cost, any cost associated with issuing new bonds, and adjusted for taxes. So what does it mean? As I said, any company which is issuing debentures or bonds, that is, for them, cost of debt is the rate of return required by investor that you have to pay to them. But this rate is actually adjusted, because to the company this is not the actual rate, it is more or less by certain other factors. So it will go up by the flotation cost. Let's say if I am spending, if I am promising to pay 8% and I raise 1 crore, but to raise 1 crore I end up spending 10 lakhs. In my pocket I got only 90 lakhs, right? 10 lakhs are paid for floating, for issuing the debentures. that is the floating cost of new bonds or debentures. So, my actual cost will go up more than 8%, it will go by a few decimals, but nevertheless companies have benefit. Companies pay taxes. If the company is making money or profit, only then company would have tax benefits. Let us say if the debentures were raised at 10% and the company falls under tax bracket of 40%, let us assume it. So, the actual cost of capital to the company would be 40% less than 10%, means it will come to 6%. So, my real cost will not be 10%, it will be reduced by 40% of 10, which is 4, so ultimately it becomes 6%. So, this is what is known as tax effect of financing with debt. So, let us have a look at this example to clarify the point I am making. So, let us say there are two companies, one is just using equity and another is using debt, right. So, with debt and with equity and with debt, there are two options to fund. So, EBIT with debt is 4 lakhs, EBIT without debt means with equity is 4 lakhs. So, one company using equity fund, another company is using debt funds. Both have earned earning before interest and tax of 4 lakhs in this example, right. Now, the company which is using only equity will not have any interest obligation, will not have any interest expense. So, what will happen? The company will have 0 interest expense. The first column with equity is showing 0. On the other hand, company which is using debt has to pay 50,000 on the debentures. So, 50,000 becomes interest expense. So, earning before tax but after interest and before tax are 4 lakhs for the company which is equity company, and the company which is using debentures, it will be 3,50,000. I hope you are looking at the example. Now, company, the tax rate is 34%. The company which is with equity will pay 1,36,000 as tax, and the company which is actually using debentures will pay 1,19,000, which is 34% of 3,50,000, the EBT. Now, earning after tax for a equity company will be 2,64,000 and a company with debt is 2,31,000. Now, the company if company pays dividend of 50,000, the retained earnings for the company with equity is 2,14,000 and with company with debt is 2,31,000. Now you can see which company is doing better with and without tax. So, this is the tax effect of financing with debenture. But important thing is, an important point to be remembered here is that dividend payable to equity shareholders and preference shareholders is an appropriation of profit, whereas interest payable on debt is a charge against profit. That is what we did here, right. Out of the profit we showed a charge of amount which we are paying as a tax. So, our tax benefit is actually available to the company who is using debt sources, because my tax liability is coming down. I am paying taxes after after subtracting interest out of the EBIT. If I am using debt only, then I will be paying interest, right. Otherwise, I will not be paying interest. Interest is paid only if certain interest obligation is there out of debentures being used, out of term loan being used or bonds being used, only then some interest obligation will be there. So, this is the tax benefit of debt which really helps companies to actually ending up with the lower cost of funds in debt case instead of equity financing or preference share financing. But to gain the full tax benefits, the company must fulfill a condition, and the condition is the company must be able to show a taxable profit every year to take full advantage of the tax shield. If the company makes losses, the tax shield goes down and cost of borrowing increases. In that case, company will not be able to get the benefit of the the percentage of tax the company is at, the bracket of tax the company is at. So, this is the tax effect of financing with debt. We should understand these aspects clearly. Now, when it comes to calculation of cost of debt, let me explain there are two type of debt. The debt which is redeemable and the debt which is irredeemable. Irredeemable means it is in perpetual form. Company is not going to pay back, it is going to stay, it is in the form of perpetuity. It is a perpetual funds, a kind of permanent funds which is not allowed nowadays. So, but there were times when perpetual funds were issued, it is very important, and they are there. So, you will think what would be the cost of the funds in that case, and the second, we will discuss that in a minute. And the second is when the company is paying back to the debenture holders after some time, after 5 years, 10 years, 20 years. So, they become redeemable. In both the cases, company is paying interest, right, either irredeemable or irredeemable. So, let us take up the first one, irredeemable, which is cost of perpetual debt. The cost of debt will be equal to the amount of interest I multiplied by the 1 minus T, which is tax rate, and the whole is divided by net proceed, NP. So, what is KD? KD stands here cost of debt. I is the annual interest payment in absolute amount. Then the T is the company's effective tax rate, and NP is net proceed of the issue, whatever. This is how we calculate the cost of debt for perpetual type of debt. Let us take up this example. AFK and company has 15% irredeemable debentures of rupees 100 each for 10 lakhs rupees. The tax rate is 35%. Determine the cost of debentures assuming it is issued at face value, at 10% premium and at 10% discount. So, in this question there are three different questions in fact. One is when the debentures are issued at face value, means if debenture is for 100, it is issued at 100 rupees only. A 10% premium means if it is 100 face value and 10% premium means it is issued at 110. 10% discount means 100 is the face value, less 10% means 90 rupees. Three different situations. So, this becomes three questions in one question itself. And then it has been given the tax rate is 35%. So, we can solve this small caselet with tax and without tax both. Look at this table calculations, which is the solution I have provided you. This is for perpetual debt or irredeemable debt. Three different situations: issued at face value, the first column, refer to the issued at first column, face value, 10% premium, 10% discount. Second column is pre-tax cost and the last column is post-tax cost. In pre-tax cost only I is divided by net proceed. I would be how much? Look at the question, 15% at the face value of 100, right? So, it means I interest is absolute amount. I small I in FM is rate of interest and capital I is amount of interest annual. So, here 15 rupees per 100 rupees of the debentures value. So, 15 divided by 15 is I and divided by net proceed, which is 100. So, rate of debt, like cost of debt in case of face value, it is issued at the face value is 15 rupees in the first situation. Same thing in case of premium, as I said, it would be 110 rupees which we will receive instead of 100. So, I is 15, premium with premium my receipts, net proceeds are 110. So, 15 divided by 110 becomes 13.7%. I am referring to second columns, friends, right. And the third row in the second column, if I am issuing at 10% discount, so my rate of interest I was 15%, the capital I amount of interest 15 divided by net proceed 90 because it is at 10% discount. So, instead of 100 my net proceeds are 90 rupees. So, my rate of interest would be 16.67%. These three calculations are without any tax consideration. Now, interesting thing is, if you want to really see the effect of tax, refer to the last column, post tax cost of debt. So, 15 is the I, amount of interest, multiplied by 1 minus tax rate, 1 minus T. T was 35%. So, 0.35 is tax rate. The whole is divided by 100, which is net proceed in the first case. So, my cost of capital becomes 9.8. Is it not interesting? The issue is face value. With on face value means 100 rupees was the net proceed. Without tax, my cost was 15% in the second column. With tax, the same cost has come down to 9.8%. Interesting. So much of saving. In the another example, the second issue was 10% premium when we are issuing at 110 rupees net proceed. Then my 15, that I, amount of interest, multiplied by 1 minus T, that is 1 minus 0.35, the whole is divided by 110. 110 is net proceed. So, the cost of capital, that is cost of debt here, 8.9, it comes even further down. And the last case, when we are issuing it at discount, at 10% discount means 90 rupees. So, I 15 into 1 minus T, that is 0.35 the tax rate. So, 1 minus 35 means actually 15 multiplied by 0.65 ho gaya. So, that is how it comes out to be 10.9%. So, this is the magic of tax benefit companies have. So, anything which is 15%, it comes down to be 9.8%, or anything which is actually 13.7% comes down to be 8.9% in case of premium. All the three examples, consciously I have actually put up them together in one slide to help you understand that the cost of debt, because of the tax benefit, is actually very low. Then it shows, or it is seemed on the instrument. On the instrument, it is 15% in this example, but in practical, with the implied cost is far less than the explicit cost of 15%. 50% we will call it as explicit cost, and the rest we calculated after tax would be known as implicit cost, which is 9.8, 8.9 and 10.9% post tax under three different situations. So, I hope you were able to understand this cost under perpetual debt. Now, I will be talking about the calculation of cost of debt, which is non perpetual, or in other words, which is redeemable, means it is to be paid. So, in redeemable debentures or bonds, which is debt only, we have to pay interest as well as we have to pay principal money. Now, this principal money can be paid in one time in the terminal year, in the maturity year, or this principal money can also be paid in multiple installments. Like interest can be paid in multiple installments, same way principal can be paid in multiple installments. It all depends how the debt has been designed. Okay. So, let us have have a look at the formula now, calculation of cost of debt for redeemable debt. So, SV is equal to, that is the cost, we have to equate, we have to calculate, we have to discount inflow and outflow. SV is equal to summation and sigma n, INT is interest, multiplied by 1 minus T, that is 1 minus tax rate. The whole is divided by 1 plus KD raised to power T, 1 plus KD. KD is cost of debt, which is, this is what we have to calculate. Right? To calculate this, we have to solve this equation, raised to power T plus RV, the redemption value. S is what we receive and RV is redemption value, divided by 1 plus KD raised to power N. So, why in the first half it is 1 plus KD raised to power T? Because interest is paid more than once, right, and it depends how much interest we are paying depending on the design of the instrument, and when we are paying the redemption value, the principal money in the redemption in the year or the maturity year, that is to be equated in only the year when we are actually paying. So, n is always the last year, 10 or 20 or whichever the life of the debt. This is the formula which is used for calculating cost of debt, which is of redeemable nature. Now, the same formula we can actually use a shortcut method as well, but there is a condition for this shortcut method I will discuss in the next slide. So, here the cost of debt with the help of shortcut formula is KD, cost of debt. So, here we are calculating straightway. In the previous slide, look at this, it was not, we have to solve the equation. KD is not, we are not calculating it for KD, we are equating SV with the outflow. SV is inflow and the right hand side of is all outflow. But here in the shortcut method, this is known as shortcut method, we are calculating KD. KD is I plus 1 minus T, I into 1 minus T plus RV minus SV divided by N. RV is redemption value, SV is the money which we receive divided by N. N is number of years. The whole is divided by RV plus SV divided by 2, the average of redemption and the money which we receive, issue price. Okay. So, what does all these symbols stand for? Let me show you, let me discuss. KD is cost of debt, I is annual interest payment in the formula, RV is redeemable value of debt or at maturity time, SV is sale value or the money we receive, sale value less discount and flotation expenses. If the issue was 100 rupees, flotation cost was 2%, I will receive 98, right. Then N is the number of years to maturity, T is company's effective tax rate. The most important thing is the note, that method which is shortcut method which I showed you on the last slide, this can be used only if the principal is payable once. So, it means it cannot be used in case principal payment is in number of installments. So, we cannot use this this one, the shortcut method, right. I hope I have helped you understand this concept of calculation of cost of debt under two different situations. First, we talked about irredeemable, where we actually solved one question, and now the last two formulas I have shown you for redeemable one. The first one we use when the payment of principal money is actually made in multiple payments. It can be used for single as well, but mandatorily for the one when we are paying principal money in more than, and if we are paying principal money only once, the shortcut method can also be used. Now, let us take up this small example. A company issues a new 10% debentures of 1000 face value to be redeemed after 10 years. The debenture is expected to be sold at 5% discount, right. Instead of 1000 rupees, I will receive less 5%, means I will receive 950. It will also involve flotation cost of 5% on the face value, means another 50 rupees I am going to lose. So, instead of 950, I will receive 900 now. The company's tax rate is 35%. What is the cost of debt be? So, let us see how can we solve it. The rate of interest is 10%. Okay. So, year 1 to 10, we are going to pay interest. How much? 100 rupees, 10% of 1000 is 100 rupees, but after tax is 35%, means I am going to pay 65. So, cash outflow of interest would be 65, the second column. Third is we have to take a guesswork here, not guess exactly, I will give you a tip for this. So, we are going to have discount factor from the table, because KD in the formula 1 plus KD raised to power T was actually or raised to power N was actually from the table. So, we take the discount factor from the discount table. So, it is 7.02 at 7%, and then the present value comes out to be 456.556. If I discount it at discount factor 8%, the discount factor is 6.71, if I multiply 65 with this factor 6.710, the present value, the last column is present value, it has gone to the next line and the table has moved. So, 435.15 is the present value of 65 interest, where we are using this discount factor from NT table, because it is from 1 to 10 year constantly every year we are paying 65 as interest. In the terminal year we are paying the debentures principal money 1000 rupees, right. Here I will take the discount factor from table only for 1 rupee table of discount factor. So, it is 0.508 at 7% and 0.463 at 8%. Okay. So, if we multiply the factor with 1000, it comes out to be 508 in 7% and 483 in 8%. If we sum up them together, it comes to be 964 rupees in 7% calculation and 899 in at 8%. So, to calculate exactly we should be interpolating, but nevertheless in this example it is close to 900. So, we were trying to equate, I will show you the formula, we are trying to equate what is my sales value 900 and we are trying to equate it with the outflow. Outflow is in the term of interest and redemption value of 1000. So, my purpose is that my left side of 900 should come equal to 900 and the right side. So, luckily 8% close, it is 899 point few cents only. So, that is why we are actually the answer is coming out to be 8%, right. So, hope you could get that, is almost close to 8%, 7.9%. If you interpolate it, you will get the exact answer. So, for calculation of this, we should actually be using the interpolation as well. So, to calculate KD, steps to be followed are, I am just summarizing, I am trying to help you here. Number 1, we calculate total present value of cash outflow during the maturity period at 2 discount rates, so as to have positive and 1 negative. See, in this example, one was 964, another was 899, right. That is first step. Second step, I am saying find KD by interpolation. So, what is the interpolation technique? Interpolation is used like this. So, KD is equal to LD, so discount rate at lower value, either 7% or 8%, you can take any of the two. Net present value of lower, if you are taking lower, then take the lower net present value. If you are taking high rate, high discount rate, which is 8%, then take the NP of 8%. Divided by the difference of 2, NPV at lower rate, that is 7%, NPV at higher rate in NPVH, and the whole is multiplied by delta D, which is H minus L. Here it is 8 minus 1, 1% only, right. That is how we can solve the calculation of debt by the second step. So, this is how the calculations are done in irredeemable redeemable debts. This is the summary that I have presented before you. I hope this is very much clear to you, that how we calculate cost of debt and how this whole concept of weighted average cost of debt is dependent upon one of the major source, which is cost of debt as well. So, friends, this is the time to wind up. We will resume the cost of debt in future, along with the cost of other sources of finances. Thank you very much for being with me. Thank you.